Welcome to Trade Savvy Academy, your go-to channel for smart investing strategies. Today, we're diving into a powerhouse topic, the top 10 ETFs you can hold forever to build long-term wealth. Whether you're seeking steady income, capital growth, or a mix of both, these ETFs are carefully selected for their reliability, low costs, and proven performance. Stick around until the end because we'll reveal a surprising insight about one ETF that could transform your portfolio strategy. Trust me, you won't want to miss it. Here's what we'll cover. First, why ETFs are a cornerstone for long-term investing. Second, what makes these 10 ETFs stand out as forever holds. Third, a detailed breakdown of each ETF, including their yields, top holdings, and key metrics. Fourth, exciting data to get you pumped about their potential. And finally, why you should stay tuned for that game-changing insight. If you love actionable investing tips, hit that like button and subscribe to Trade Savvy Academy for more content like this. Let's start with why ETFs are a fantastic choice for long-term investors. Exchange-traded funds, or ETFs, are investment vehicles traded on stock exchanges, holding a diversified basket of assets like stocks or bonds. They're perfect for building wealth because they offer lower expense ratios than mutual funds, often below 0.5%, and they're tax-efficient, minimizing capital gains distributions. ETFs also provide instant diversification, reducing risk by spreading your investment across hundreds or thousands of companies. The 10 ETFs we're covering today are JPMorgan Equity Premium Income ETF, iShares Preferred and Income Securities ETF, Schwab U.S. Dividend Equity ETF, Fidelity High Dividend ETF, Vanguard High Dividend Yield ETF, SPDR S&P Dividend ETF, iShares Core Dividend Growth ETF, Vanguard Dividend Appreciation ETF, First Trust Rising Dividend Achievers ETF, and Vanguard S&P 500 ETF are handpicked for their focus on dividends, low costs, and historical outperformance, making them ideal for holding indefinitely. Why are these ETFs the cream of the crop? It comes down to three core strengths: consistent income, diversification, and stability. Most of these ETFs focus on dividend-paying stocks, which have historically outperformed non-dividend stocks while providing a steady cash flow, perfect for reinvesting or supplementing income. Their yields range from 1.5% for broad market exposure to a juicy 8 to 9% for income-focused funds catering to various investor goals. They also boast low expense ratios from 0.03% to 0.50%, ensuring more of your money stays invested. Plus, they're managed by trusted issuers like Vanguard, Schwab, and JPMorgan, offering peace of mind for decades-long holding. These ETFs are built to weather market storms, with many showing resilience during downturns, like the 2008 financial crisis. If you're enjoying this deep dive, don't forget to like and subscribe to Trade Savvy Academy to keep learning how to grow your wealth. Now, let's get into the heart of this video, a detailed analysis of each ETF, exploring their strategies, yields, top holdings, and why they're forever holds. First up is the JPMorgan Equity Premium Income ETF, or JEPI, which delivers a high yield of 8 to 9% with an expense ratio of 0.35%. JEPI invests in large-cap U.S. stocks like Microsoft, Apple, and JPMorgan Chase, while using a covered call option strategy to generate extra income and provide downside protection. This makes it a favorite for income-focused investors who want stability during market volatility, cementing its status as a forever hold for those prioritizing cash flow. Next, we have the iShares Preferred and Income Securities ETF, PFF, yielding 6 to 7% with a 0.46% expense ratio. PFF focuses on preferred stocks from financial giants like Wells Fargo and Bank of America, offering a hybrid of bond-like stability and equity upside. Its steady income stream makes it a reliable choice for investors seeking consistent payouts without excessive risk. Moving on, the Schwab U.S. Dividend Equity ETF, SCHD, is a standout with a 3.91% yield and an ultra-low 0.06% expense ratio.
SCHD tracks the Dow Jones U.S. Dividend 100 Index, targeting high-quality companies like Texas Instruments and Broadcom, with at least 10 years of consecutive dividend increases. Boasting a 10-year annualized return of 10.26%, it's perfect for balancing income and growth, making it a cornerstone for long-term portfolios. The Fidelity High Dividend ETF, FDVV, offers a 3 to 4% yield with a 0.29% expense ratio, focusing on large and mid-cap dividend stocks like Chevron and ExxonMobil. Its emphasis on energy and financials, combined with diversification, appeals to investors seeking higher yields with growth potential. Then there's the Vanguard High Dividend Yield ETF, VYM, with a 2.84% yield and a 0.06% expense ratio. Tracking the FTSE High Dividend Yield Index, VYM holds stalwarts like ExxonMobil and Johnson & Johnson, delivering a 9.99% 10-year annualized return. Its broad exposure and low cost make it a no-brainer for income-focused investors. The SPDR S&P Dividend ETF, SDY, yields 2.5 to 3% with a 0.35% expense ratio, targeting SP high-yield dividend aristocrats. Companies like 3M and Coca-Cola with 25-plus years of dividend increases. Its focus on stability and consistent dividend growth ensures it's a forever hold for conservative investors. The iShares Core Dividend Growth ETF, DGRO, yields 2 to 3% with a 0.08% expense ratio, investing in dividend growth stocks like Microsoft and Apple. By tracking the Morningstar U.S. Dividend Growth Index, DGRO balances current income with future growth, ideal for those planning decades-long investments. Similarly, the Vanguard Dividend Appreciation ETF, VIG, also yields 2 to 3% with a 0.06% expense ratio, focusing on companies like Microsoft and ExxonMobil that consistently raise dividends. Its S&P US Dividend Growers Index tracking ensures both income and capital appreciation, a winning combo for long-term wealth. The First Trust Rising Dividend Achievers ETF, RDVY, delivers a 3 to 4% yield with a 0.50% expense ratio, targeting companies like Broadcom and Target with at least 5 years of dividend increases. By tracking the NASDAQ U.S. Rising Dividend Achievers Index, RDVY offers growth potential through rising payouts, appealing to income and growth seekers alike. Finally, the Vanguard S&P 500 ETF, VOO, rounds out the list with a 1.5% yield and a rock-bottom 0.03% expense ratio. Holding top names like Apple, Microsoft, and Amazon, VOO tracks the S&P 500 for broad market exposure, delivering a 10.26% 10-year annualized return. While not dividend-focused, it's a core holding for diversified, long-term portfolios. Before we move on further, if this breakdown is helping you plan your investments, smash that like button and subscribe to Trade Savvy Academy for more insights. Let's talk about what makes these ETFs so exciting for investors. Historical data shows their strength. SCHD and VOO both clocked 10.26% 10-year annualized returns, while VYM's 9.99% return is nearly as impressive. Dividend-focused ETFs like these have historically outperformed non-dividend stocks, offering stability during market downturns, as seen in 2008 when dividend payers held up better than growth stocks. Their yields, ranging from 1.5% to 8 to 9%, cater to every investor's needs, whether you're after high income with JEPI or broad market growth with VOO. Low expense ratios, some as low as 0.03%, mean more of your money compounds over time. Plus, these ETFs are backed by issuers with decades of expertise ensuring reliability. There's some debate about high-yield ETFs like JEPI, which prioritize income over growth, but their flexibility allows you to tailor your portfolio to your goals, whether that's early retirement or legacy wealth. Now, why should you stick around until the end? We're about to share a surprising insight about one ETF that could shift how you approach your portfolio. But first, let's wrap up why these ETFs are forever holds. Their diversification across sectors like technology, financials, and consumer goods reduces risk, while their low costs maximize returns over decades. Dividend stocks, which dominate most of these ETFs, have a proven track record of resilience, making them ideal for weathering economic cycles. Whether you're a beginner or a seasoned investor, these ETFs offer something for everyone, from JEPI's high income to VOO's market-beating growth. If you're excited about building wealth with these ETFs, like and subscribe to Trade Savvy Academy to stay in the loop. Here's the game changer we promised. JEPI's unique option strategy not only delivers an 8 to 9% yield, but also acts as a hedge against market downturns, making it a secret weapon for income investors. Unlike traditional dividend ETFs, JEPI's covered call approach generates extra income, which can be reinvested to supercharge your portfolio's growth. This makes it a must-consider for anyone looking to balance risk and reward, especially in volatile markets. To sum it up, these 10 ETFs are your ticket to long-term wealth. Their combination of income, growth, and stability, backed by historical performance and low costs, makes them perfect for holding forever. For more investing strategies, hit that like button, subscribe to Trade Savvy Academy, and turn on notifications so you never miss a video. Thanks for watching, and we'll see you in the next one.